Imagine this. While the stock market surges on AI hype, one massive sector, worth trillions, is quietly trading at rock-bottom prices, cheaper than it's been in decades. That's U.S. health stocks right now. In 2025, they've lagged behind, down 5% while the S&P 500 climbs over 7%. But savvy investors are spotting the rebound potential. With an aging population, groundbreaking innovations, and valuations screaming buy, could this be your next big opportunity? Let's break it down. In this video, we'll explore 5 key reasons to pay attention, backed by current trends, data, and expert insights. We'll also spotlight top stocks and subsectors to watch. By the end, you'll have a clear picture of why health stocks deserve a spot in your portfolio. Let's get started. First up, attractive valuations and the potential for bargain hunting. Right now, healthcare stocks are trading at a steep discount compared to the broader market. The sector's forward price-to-earnings ratio, or PE, is around 16, while the S&P 500 is at 22. That makes healthcare the second cheapest sector, just behind energy. This level of relative cheapness hasn't been seen in nearly 25 years, and the sector's weight in the S&P 500 is at multi-decade lows. Why does this matter? It means investors can buy high-quality companies at prices that don't fully reflect their growth potential. For perspective, U.S. healthcare spending is expected to grow by 5.8% annually through 2033, reaching over $7 trillion. This surge is fueled by an aging population and the rise in chronic diseases like diabetes and heart conditions. Yet, despite these strong fundamentals, the S&P 500 healthcare index is down about 5% year-to-date, contrasting sharply with the overall S&P's gains. Analysts point out that this mismatch creates a classic value play. Bargain hunters are already stepping in, seeing the sector as undervalued. Over the past 2 years, we've seen outflows from healthcare funds, but as investors tire of overpriced tech stocks, money could flow back here. Think of it like shopping during a sale. You're getting durable, essential businesses at a fraction of their worth. To analyze this further, consider historical patterns. In past cycles, when healthcare valuations dipped this low, rebounds followed as economic stability returned. With inflation cooling and interest rates potentially stabilizing, the setup looks promising for a valuation reset. Moving on to reason number 2. The defensive qualities of healthcare in an uncertain economy. Healthcare is what we call a defensive sector. That means demand for its products and services, things like medical treatments, drugs, and devices, stays steady even during economic downturns. People don't stop needing care for serious conditions just because the economy slows. In today's environment, with rising market volatility, think recent spikes in the VIX index, and whispers of a potential slowdown, this stability is a big plus. Healthcare stocks often hold up better than cyclical sectors like technology or consumer goods, which fluctuate with economic moods. Recent data shows significant outflows from the sector over the last 2 years, but experts predict a reversal. As investors rotate out of overhyped areas like AI, they may seek safer havens. Plus, margins are expected to improve in 2025. Labor shortages that plagued hospitals and providers are easing, and companies are regaining pricing power through renewed contracts. Let's break this down analytically. In recessions, healthcare revenue dips less than other sectors, historically by only 2 to 3% versus 10 to 15% for the broader market. With chronic diseases affecting millions and an aging baby boomer generation, demand is baked in. This defensiveness isn't just theoretical, it's proven. During the 2008 financial crisis and the 2020 pandemic, healthcare outperformed or recovered faster than many peers. Investor sentiment on platforms like X reflects this too. Many are advising to ignore the noise and focus on the sector's resilience. In short, if you're worried about economic headwinds, healthcare offers a buffer without sacrificing growth. Now, let's talk about what really excites me. Innovation and growth catalysts in healthcare. This sector isn't just stable, it's evolving rapidly, with breakthroughs that could deliver outsized returns. First, AI integration. Artificial intelligence is revolutionizing everything from drug discovery to diagnostics, imaging, and patient monitoring. It could save insurers between $150 million and $300 million per $10 billion in revenue through efficiency gains. Companies in medical devices and data analytics are leveraging AI for mid-single-digit revenue growth, making them prime picks. Next, the boom in weight loss and specialty drugs. GLP-1 agonists used for obesity and diabetes are a massive trend. Obesity affects 1 in 8 Americans, creating huge demand. Leaders like Eli Lilly and Novo Nordisk are at the forefront, but the benefits ripple to biotech and pharma overall. Then there's biotech breakthroughs. Small-cap biotechs are where the action is, with potential in oncology, immunology, and gene therapies. Earnings seasons often spotlight these, and M&A activity, mergers and acquisitions, is set to rise in 2025 as companies strengthen their balance sheets and form partnerships. Demographics play a key role here too. The U.S. population is aging, boosting needs for Medicare Advantage plans, surgical robotics, and chronic disease management. This isn't hype, it's a structural shift. Analyzing the potential. AI alone could add trillions to global healthcare value by optimizing processes. Weight loss drugs are projected to be a $100 billion market by 2030. Biotech M&A hit record levels in recent years, signaling confidence. For investors, this means not just stability, but explosive growth in subsectors. Focus on companies with strong pipelines and patents. They're the ones likely to surge. Reason 4. Policy and regulatory tailwinds that could turn the tide. Admittedly, short-term challenges like the Inflation Reduction Act's drug price negotiations, potential tariffs, and policy shifts from past administrations have created uncertainty. These have weighed on sentiment and contributed to the sector's lag. But looking ahead, stability might emerge. Proposals to reverse cuts to Medicaid and the Affordable Care Act could provide visibility, especially since these programs impact about 40% of revenues for giants like UnitedHealth. As payer mixes shift toward more profitable commercial segments and subsidies phase out, profitability should climb. From an analytical standpoint, regulatory noise often creates buying opportunities. Once policies settle, perhaps post-elections, clarity boosts confidence. Investor discussions on X emphasize zooming out to a 10-year horizon, where exploding boomer spending overshadows short-term hurdles. In essence, while risks exist, the horizon looks brighter. Healthcare's essential nature means governments prioritize access, often leading to supportive frameworks. This could catalyze a sentiment shift, drawing in more capital. Finally, reason 5. Strong performance from select stocks and subsectors. Not every health stock is a winner, so focus on those with durable advantages. Let's look at some standouts. First, UnitedHealth Group, ticker UNH. It's an insurance and services, down 15% over the past year due to an undervalued reset. But with scale in Medicare Advantage and free cash flow projected at over $25 billion by 2027, it's trading at less than 10 times price to free cash flow. Analysts' consensus price target is $1,144 from 24 experts. Oscar Health OSCR is a disruptor in insurance, up 20% amid volatility. It's growing revenue at 78% annually and expanding markets, offering asymmetric upside at 7 times 2027 EPS. Eli Lilly LLY focuses on pharmaceuticals, especially GLP-1 drugs. Up 45% in a year, it's a leader in weight loss and oncology innovations. CFRA's price target is $441. Intuitive Surgical ISRG in medical devices for robotics is up 30%. It dominates robotic surgery with steady demand. Celcuity Inc., CELC, a biotech, shows 45.7% returns in the last 30 days. This clinical stage with high risk, high reward potential. Analyzing these, quality names like UNH have moats from scale and data. Growth plays like Eli Lilly ride megatrends. Diversify across subsectors to balance risk, biotech for upside, insurers for stability. Always check your risk tolerance. Policy changes could add volatility. In summary, U.S. health stocks are undervalued, defensive, innovative, poised for policy wins, and home to strong performers. While challenges remain, the long-term outlook is compelling. As one investor noted, ignore the noise and zoom out. Healthcare is going nowhere. Thanks for watching and invest wisely.